In this recording, I will cover how the assumptions in the case study can be translated into financial analysis. So step one is to look at the assumptions that are provided. So when you're putting together an Excel spreadsheet for a project where you are looking at forecasting cash flow, which will eventually lead into, does this project make sense or not, looking through the lens of net present value and internal rate of return. So here, the assumptions that are provided to us in the case study are the sales forecast. And again, what I've shown over here are the assumptions number that you can look into the case study. So information provided to us, A, how many they think they're going to sell. So as you read the case study, they've done some market analysis, and they have forecasted what the revenue, the sales will be in terms of millions of sneakers they are going to sell. They've also done some analysis, and based on the average price, they've estimated the price to be $115 per sneaker. But when they're going to introduce the new sneaker, the introduction of the new product will end up negatively affecting their existing product. So they estimate that there will be cannibalization, also called erosion, which means that the revenue from the other sneakers that are currently in production will get cannibalized because people will buy new sneakers. So they have to estimate what the cannibalization will be. So they've estimated the cannibalization in 2013 to be 35 million, and in 2014 to be 15. In order to figure out the variable cost, also called cost of goods sold, they've assumed, this should not be a dollar sign, they've assumed 55% of revenue. So this number should be 0.55. Now that dollar sign should not be there. 0.55% of the revenue is how they get to the cost of goods sold. They've estimated the SG&A expenses to be $7 million a year across the board. Endorsement that they will have to pay to athletes, another $2 million. Other advertising costs have estimated to be 25, 15, 10, 30, and 15. And again, these are all, you can find them in the case study in these assumptions. They also know that in order to produce, there will be need for some working capital. Working capital has basically three components. One is going to be accounts receivable. They're estimating, based on their experience and prior product line, that the accounts receivable will be 8% of the net sales. So net sales will be sales minus the cannibalization effect. Inventory, they're looking at it, would be a percent of variable cost, or again also called cost of goods sold. It's going to be 25% of whatever the variable cost is. And again, variable cost will be 55%, 0.55 times 115. I'm sorry, price per pair times the the sales price. The accounts payable will be 20% of the variable cost. For the new product, they'll have to invest some money up front, about 150 for factory expansion, plus another 20 that would include equipment and installation. They've described in the assumption 6 and 7. In addition, they will also need some startup inventory. When you start, obviously, before you're going to start to produce, you need to have some inventory for raw material that you will need to make sneakers. You have to have it up front. And they will have some accounts payable because they're going to buy material from the suppliers. So this is in year 212, in the lingo financial analysis, that would be considered as year 0, starting point. The tax rate is 40%. So in 2012, they'll be doing investments in terms of producing the factory, etc. So there is no production sales going on. Starting in 2013, they're going to start to produce, sell, so that's where the revenue is going to come in. The other piece of information that the case study has provided is that this project is going to last about 6 years, which means that 2018, this project will be, quote unquote, completed, finished, and put away. So they're estimating that the 150 million they're investing up front in all the factory expansion, that in year 2018 it will be, they can sell it in used market for 102. And for the equipment installation that they're spending 20, they can sell it for about 3. Okay. And also the depreciation schedule, because of the factory typically lasts a lot longer, so it would be depreciated on a 30 years basis, equipment 5 years basis. So they provided us a depreciation schedule for year 13, 14, 15, 16, 17, and 18. The top one over here is for the factory, and the bottom one here is for the equipment. And this would be, we will need to be able to figure out what to put in the income statement. So anyways, any analysis, you have to look at the assumptions. You're going to lay it all out. So in this case study, we do that. Now, what is our end goal? Our end goal will be, is to come up with, does this project make sense? So you'll be applying net present value and IRR. In this example of the case study, they said the discount rate of the hurdle rate is 11%. So how do we come up with this number? What we'll have to do is to come up with the free cash flow. In order to get the free cash flow, we need these pieces. So what are the pieces? We will need earnings before interest and EBIT after taxes. So we'll get that. We'll have to calculate that information. Then we will add back the depreciation. Add back the depreciation for both the factory and for the equipment. We'll have to calculate the change in working capital. We'll account for the investments made up front, and that's going to give us the free cash flow. From there, we can use the NPV and IRR calculation to do that. So how do we come up with some of these pieces? EBIT will come from the income statement. So we'll have to create an income statement. And the income statement will be the revenue. Again, that will be the price per sneaker times the quantity they are selling for each year. Cannibalization, obviously, will be a negative number. So you get the net revenue after that, which would be 138 subtract 35. Variable cost is going to be 55%, 0.55 of the net revenue. So it is 56.65 is calculated. The percent provided to us is 0.55. From there we get the cost of goods sold or the variable cost. SG&A provided is 7 million, endorsement 2 million, advertisement 25, 15, so on. Then the depreciation will be calculated using the depreciation schedule that was provided to us times the amount, the money we spent, which would mean in the case of factory we spent 150 times the depreciation schedule for 2013 would be that number, and then 2014 schedule times the 150 will be that number. Similarly, for the equipment, we do the same thing. From there, we get the EBIT. They don't have any interest expense, so that's earnings before taxes, taxes, net income. From here, we have enough information to be able to get the EBIT, which is earnings before interest and taxes. How do we do that? We take the EBIT and we multiply that by 1 minus tax rate, which will give us EBIT. So other piece of component we need is the working capital. The working capital information they provided us in the assumption is that the accounts receivable will be 8% of net sales, inventory will be 25% of the variable cost, and the accounts payable will be 20% of the variable cost. In order to start in 2012, we will not have any accounts receivable because we have not sold anything yet. But we will have to carry some inventory. We'll have to buy some raw materials, some rubber, some shoes, material that we need. We will be borrowing, we will be getting it from supply. That would be the accounts payable. The working capital formula is we take accounts receivable plus account inventory, subtract accounts payable. So in this case, we have 15 minus 5 is 10. Starting 2013, we will use the formula that is up here times the net revenue for accounts receivable and percent for variable costs. From there, we will get the working capital. The change in working capital is what we need for cash flow. So what is that? Obviously, we're starting from year 1 at 10. Next year, we would need to grow by 1.0725. How do we do that? It is, we have 10, but we need 11.0725. So that means we are adding one more. So this number is basically 11.075 minus 10, continuing this way. So this would be the working capital. The reason these are zeros in the last year is when the project is over, we are not going to be getting more inventory. We are done with the project. So basically in that year, it would be 0. So from that point of view, this is what you're going to get for the change in net working capital. The other piece we will also need to know is the salvage value. What will the cash flow value be, right? So what are we looking for? We are looking for the salvage value for the equipment that is going to be sold at 102,000 and then also in 3 years, and this will take place in year. These numbers will take place obviously in 2018. I just put it over here so I can do the calculation for you. So they're planning to sell it to 102 if you read the case study in year 2018. So the first thing we have to do is to figure out the book value. So the book value is calculated basically by taking the value of what we invest, and we keep subtracting what is being depreciated. And so the best way to do that is to take your depreciation schedule and you can accumulate it. So it was 0.26. If I keep adding up the depreciation schedule, basically that means the factory equipment, which will take 30 years to depreciate, by the end of 2018 would have depreciated 25% or 0.251 of it. For the Macker's 5 years, for the equipment, it will be 20% in year 1. By the time you get to the 6th year, it will be depreciated all, 100% of it. So the book value basically is the amount you have, which is 2012, it will be 150, which is the gross value we paid for the factory and for the equipment. And then we continue to reduce it by subtracting this amount. So if I take this and subtract this times that number, I will get this number, and so on. So this is the book value for factory, and this is the book value for equipment. So now that we have the book value, this is how the calculation is done. We look at the price that we are going to get for the used equipment for the factory in 2018. We look at the book value in 2018, which is 112. Subtract from it, we get a net book profit is negative 10.35. We multiply that by the tax rate, which is 40%, so it is 10.35 times tax rate. And the net cash will be 102 minus the taxes, so it will be 106 over here. Equipment basically was 3, book value is 0, obviously, so the net book profit is 3. We'll pay taxes 1.2, and we're going to end up with 1.8. So these are the numbers we're going to end up in 2018 by selling our equipment and after paying any taxes that are required to be paid. So again, back to where we started from the net income, EBIT, which is basically EBIT after taxes, which is EBIT times 1 minus tax rate, you will get these numbers. We add back the depreciation for both factory and for the equipment. We get the change in working capital. We are investing 150 and 20. We add them all up, we get a free cash flow, and this is the line, minus 180, 950, 29.7, and so on. So this is a free cash flow line over here. We use that free cash flow line using a discount rate of 11%. You'll get the NPV of 13.36, and the IRR will be 12.8%. And so that's how you do the process of getting from the assumptions into the cash flow.